Hello, everyone. This is Jillian Verdun from JMV Financial Services, your profit strategist, bringing tips and tricks to improve your financial situation for the new year. I'd like to thank you again for tuning in to us today. We get to talk about 8-year-end tax tips. This tax season, you'll want to be prepared and informed about how to maximize your return and ensure that your tax documents are error-free to avoid any audits. Getting started on your tax documents early offers you the benefit of being able to revisit your already completed tax paperwork near the end of the tax year prior to filing. Revisiting your taxes with a fresh eye can help you notice any discrepancies you may have or have not missed, as well as helps you to apply knowledge about how to maximize profits with tax tips that you have learned throughout the tax year. Tax payments enables the government to collect funds that help provide essential amenities to communities. It is thus critical for every individual to adhere to the tax rules placed in their region. However, there are legal ways that can help reduce tax charges. Some of the end-year tax tips include the following. Number 1, 401k and HSA contributions. Remitting a 401k and an HSA health savings account contribution reduces the income tax charged on an individual or small business. If your tax rate falls in a higher category, remitting this contribution will enable you to fall back into a lower class, reducing the amount paid. Number 2, hold off on mutual fund purchases. Mutual purchases incur tax that is charged on dividends issued to members. Holding off from buying them towards the end of the year ensures that you do not get charged with the tax on the money you may have not yet enjoyed. You can thus wait to buy the shares at the beginning of the year to ensure you get excellent dividends. Number 3, convert money from a traditional to a Roth IRA. Converting money to a Roth IRA is a tax-saving mechanism, as the former is tax-free. However, it helps if you are careful about the amounts you move and ensure it does not alter your tax bracket as you get charged for the quantity converted. Number 4, harvest your capital losses. Harvesting capital losses is a strategic move to reduce federal tax and reduces the amount of taxable income. It enables the person to get up to $3,000 that can be used to pay towards their taxes. Tax loss harvesting is a great strategy that can be used by small business to enable it to cut down its tax amount. Number 5, pick up capital gains if you're in a low tax bracket. Capital gains in a low tax bracket may attract zero tax charges. You can thus utilize this window to sell stocks and make a profit. Number 6, invest in qualified opportunity zones. Qualified opportunity zones are areas housing vulnerable communities. Investing in these zones is thus a way of giving back and a tax-free investment opportunity. The money gets put to task for 7 years, then returned to the owner. Therefore, a person can utilize the time to identify projects they can channel the money and evade high taxes. Number 7, use your flexible spending account balance. Flexible spending accounts hold money that is set back to the employer at the end of the year. Thus, an individual can use this money to carry out various activities such as healthcare bills, as you do not pay tax on the money spent from this account. Number 8, last but not least, meet with your tax advisor. Tax advisors understand tax laws and regulations. They can spot loopholes and offer valuable counsel. Tax advisors ensure you are correctly classified and identify various classifications that will enable you to pay the required minimum. Thus, They are an excellent guide for a small business that wishes to grow its business by helping it save money lost in hefty tax. Again, we'd like to thank you for listening to us today, and please follow us on your favorite podcast. Bye.